Then in part B, calculate the fair market value of an 80% equity interest in Prestige as at 31 December 2019. All right, so we need to value an 80% equity interest in Prestige, and you're not told what valuation method to use. So remember, you need to use the information provided in the scenario as a guide. Based on the information provided, you should be able to determine what valuation method to use. So, for example, guys, if you want to perform a valuation using the free cash flow method, you need to be able to calculate the cost of debt and the cost of equity so that you can calculate the WACC, because remember, we use the WACC as our discount rate. So you would need that information. You would need information to be able to forecast cash flows into the future, because the free cash flow method always works with forecast or future free cash flows. So if you have that information available, you can perform the valuation using the free cash flow method. Now, we saw when we read through the information provided in the scenario, we don't have that information available for Prestige. However, what information do we have? We have been given an extract from the statement of profit or loss and other comprehensive income. So we have historical earnings over here for the last 3 years. And in addition to that, we have also been given the multiple, an earnings multiple of a similar listed company. Now remember, guys, whenever you are performing a valuation, your earnings multiple and the earnings of the company that you are valuing must always be comparable. So we've been provided with the market value of invested capital over earnings before interest and tax multiple. So if this is the multiple that we are going to be working with, then in step 1, when we are calculating maintainable earnings, we are going to be calculating maintainable earnings before interest and tax, so that the multiple and the earnings figure are comparable. All right, and guys, there's no excuse. You must study the steps and the frameworks that I've provided you with in the lecture, because if you've got those steps, you know exactly what you need to do in order to perform this earnings-based valuation. What do we do in step 1 when we have an earnings-based valuation? We always first calculate maintainable earnings. So that's what we're going to start with over here. Let's calculate maintainable earnings for Prestige. And we are going to be calculating earnings before interest and tax so that the earnings figure is comparable to the multiple that you've been provided with for the similar listed company. All right, so it's pretty obvious what valuation method you need to use over here, because you don't have information available to perform the valuation using any other method. You have to use earnings multiples. All right, so in step 1, we calculate maintainable EBIT. All right, for Prestige Pty Limited. Then, we've been given earnings information relating to Prestige for the last 3 years, for 2019, for 2018, and for 2017. And remember from our lecture, guys, we are not just going to look at the earnings information for 2019, because we are trying to estimate the earnings that will be maintainable in the future. It's in the name. We want maintainable earnings. So earnings that the company will be able to maintain or sustain in the future. Now, the only way we can perform this is by using all of the year's information that we've been provided with and determining whether or not we have a trend. So please, when you're performing the calculation, don't only focus on 2019. You must look at all 3 years. Then, once we've calculated maintainable earnings, we'll look if we have a trend. If we have an increasing trend in our earnings, we'll use the most recent figure as the maintainable earnings in our valuation. Remember, what do we do if we don't have an increasing trend? If we have movement like this, there's no trend, we are then going to calculate a weighted average. All right. But that is the logic behind why we don't only focus on 2019, why you need to include all years in your calculation, because we are trying to estimate what the maintainable earnings will be in the future. All right. Now, we are trying to calculate maintainable earnings before interest and tax. So I'm going to start my calculation over here with operating profit, which is obviously before interest, it's before the finance costs, and it's also before tax. You could start your calculation at this point over here, the profit before tax, but then obviously you're going to need to add back the finance costs because we are trying to calculate EBIT, and we need this to be before interest and tax. So regardless, you'll still get the same answer, but just make sure you understand the logic. To save some time, I'm going to start over here with operating profits. All right, for all 3 years, guys. And I'm going to keep the same level of rounding that we have in the question. Everything over here has been rounded to the nearest 1,000 rand. So I'm going to keep that same level of rounding. It just makes everything a little bit quicker. Then remember, when we are calculating maintainable earnings, like we said, we are trying to determine the earnings that will be maintainable in the future. So if there's any expenses that you don't expect will happen again in the future, we need to eliminate those expenses. So any once-off expenses that, or non-recurring expenses that we don't think will happen again in the future, need to be eliminated. Then if there are any investments, that investment income should be excluded from here because we are going to value non-operating assets or investments separately. So any non-operating assets will be valued separately, and any income from those non-operating assets should be excluded from your maintainable earnings calculation. In addition to that, if we have any expenses that are not market related, we need to adjust for those to make sure that they are market related. We also need to make sure that all of the expenses that are going through the statement of comprehensive income are legitimate business expenses. So for example, if we have situations where family members are being paid but they're not actually employees of the company, those are not legitimate business expenses and should be excluded. If one of the directors goes on holiday and he puts that through the company, the cost through the company, once again, it's not a legitimate business expense, so that cost should be excluded. So if there's anything like that, we need to process certain adjustments so that we can come down to the maintainable earnings that we expect the company will have in the future, and it only includes business expenses, and all of the expenses are market related or reasonable. So we were specifically told that operating profit includes the following. First, we have equipment with a book value of 4.2 million rand, was sold for 2.5 million rand on the 31st of October 2019. So this will obviously affect the 2019 financial year. Now guys, we are dealing with Prestige over here. We are trying to value Prestige, and Prestige is a university. They are not in the business of selling equipment. So the profit or loss on the sale of this equipment is not operating in nature. So it needs to be excluded from the operating profit figure. Now over here we definitely have a loss because we can see the equipment is being sold for less than its book value. So we have a loss on the sale of this equipment. It is not operating in nature. It's got nothing to do with their normal business activities. Prestige does not exist to sell equipment. They sell tuition. They are a university, all right? So this is not an operating expense. It needs to be excluded. So what do we need to do? Let's just calculate what this loss is, and we can then exclude it from the operating profit in 2019. All right, and because we are dealing with a loss, obviously the loss would have been deducted when calculating the operating profit, so we now need to add that loss back in order to eliminate it. All right, and you didn't have to give any reasons. If you go back to the required over here, we only need to calculate the fair market value. You don't need to give reasons for why you're including things in the valuation and why you're not including things in the valuation, etc. Please make sure that you always read the required very carefully, just in case you need to give reasons for all of the adjustments that you process. But if you did need to give a reason over here, you could say it's because this is not an operating expense. So because it's not an operating expense, we need to exclude it from the calculation of maintainable earnings. All right, so the equipment was sold for 2.5 million rand. Just remember, we are rounding to the nearest 1,000 over here. and the equipment had a book value of 4.2 million rand. So we have a loss of 1.7 million rand that was taken into account when calculating the operating profit in 2019. So we need to add that loss back so that we can eliminate it from operating profit. There's obviously no adjustment in 2018 or 2017. All right, then we also have directors' salaries that are not market related, because these salaries are 20% less than market related salaries. So you've been given the salary that's been recorded in the accounting records. So these salaries have been included in the calculation of operating profit. You've been given the salary for 2019, for 2018, and for 2017. But the salary that has been recorded in operating profit is 20% less than market-related salaries. So the expense has been understated. We are going to have to expense an additional 20% so that we make sure that the expense is reasonable and it's market-related. So just be careful here, guys, because what most people tend to do is just take this expense and multiply it by 20%, and then you want to expense a further 20% like that. That's not correct. Why can you not do that? This is not the total expense. This is 80% of the total expense because it's 20% less than the market-related salary. So the market-related salary is 100%, and this is 20% less than a market-related salary, which means all of these costs that you've been provided with over here are 80% of the total market-related salary. So you can't just take these amounts over here and multiply by 20% to get the additional expense to make sure that this is market related. What do you need to do? You multiply by what you want and you divide by what you've got. What do we want? We want this extra 20% because that's what we need to expense. 80% has already been expensed. We need to expense another 20% so that the full amount is expensed. So we are trying to get the extra 20%. We want the 20%. So multiply by what you want. Divide by what you've got. These numbers that you've been provided with here are 80% of the total expense, not 100% of the total expense. That's why you can't just multiply by 20% to get the answer over here. That is incorrect, guys. You need to multiply by 20 over 80, and that will give you the additional 20% that you need to expense to take you to 100%. 80% has already been expensed in the calculation of operating profit. So we need to deduct this additional expense. So for 2019, once again, guys, just remember to round to the nearest thousand. It's 15.4 million rand, rounded to the nearest thousand. Multiply by what you want and divide by what you've got. And you follow exactly the same logic for 2018 and also for 2017. We are trying to calculate the additional 20% that needs to be expensed. 80% has already been expensed over here. We are now trying to expense the additional 20% so that the full cost is expensed. All right. All right, then we have finance costs being deducted, and that gives us profit before tax. Now, we are trying to calculate maintainable earnings before interest and tax, so I'm obviously not going to deduct these finance costs over here, but don't leave it out. Show that you've considered the finance costs, but don't actually deduct them. All right. And the logic behind not deducting finance costs is because we are working with earnings before interest and tax, which means debt is going to be valued separately. That's why we do not deduct the finance costs. We work with earnings before finance costs or before interest. Okay, we will value debt separately. All right, so I'm not deducting the finance costs because I started with operating profit, so don't deduct the finance costs. Obviously, if you started your calculation with profit before tax, so if you started your calculation over here, then you would need to actually add back the finance costs so that you have your earnings before interest, and then you'll value the debt separately at the end. So just check where's the starting point of your calculation, because that determines what you need to do. If you start here, you need to add back the finance costs. If you start here, do not deduct the finance costs. But obviously, if you understand the logic behind what you're doing, then it doesn't matter where you start your calculation, because you'll come down to exactly the same or the correct answer in the end. Okay, so we can now calculate a subtotal over here, and that's going to give us our maintainable EBIT. So remember, we said the whole reason why we are using all 3 years in our calculation is because we are trying to determine whether we have an increasing or decreasing trend in our earnings. And you can see the earnings or maintainable EBIT increases from 2017 to 2018 and increases again from 2018 to 2019. So we have an increasing trend in our earnings. And because we have an increasing trend, we are going to use the most recent year as our maintainable earnings figure. Please remember, guys, if you don't have an increasing trend, so if the earnings drop and then they increase, or if they increase and then they drop, you can't use the most recent year. You then need to calculate a weighted average. Right, but just show the examiner there's an increasing trend, so therefore we should use the most recent year as maintainable EBIT. So our maintainable EBIT, just remember we rounded everything above to the nearest thousand. That is the maintainable EBIT figure that we are going to use in our valuation. All right, and that deals with step one. Step one is done. We've determined maintainable EBIT. Now in step two, you need to calculate the adjusted multiple. Okay, and we are working with the market value of invested capital over earnings before interest and tax multiple. So remember, what do? First, you start with the multiple of a similar listed company, and we are then going to adjust for entity level differences. So if you go back to the information provided in the scenario, the JSE listed university has a multiple of 12 as at the 31st of December 2019. So that is the multiple of the similar listed company. And now we need to consider entity level differences. Now please make sure that you study the list of entity level differences that I've provided you with in the lecture. You can then go through that list and consider which adjustments are necessary. So the first adjustment that we need to consider is for any differences in gearing or the level of borrowing. Now, if you go back to the information provided in the scenario, we were specifically told that the listed university has a lot more debt in its capital structure than Prestige. So normally, for example, if we were working with a price earnings multiple, which is based on earnings after interest and tax, we would adjust for differences in gearing. However, in this scenario, we are dealing with the market value of invested capital over earnings before interest and tax multiple. So because we are working with this multiple over here, we should not adjust for differences in gearing because the multiple is based on earnings before interest and tax. So please guys, I'll specifically put this in to try and create a little bit of confusion. Do not adjust for differences in gearing because of the multiple that we are using. But don't just leave that out. Show the examiner that you know you should not be adjusting for differences in gearing. Otherwise, it looks like you've just forgotten. Okay, so this is not applicable because we are working with a market value of invested capital over EBIT multiple. So we won't make an adjustment for differences in gearing. Then we need to look at the level of competition. And if the two companies are facing different levels of competition, we need to make an adjustment. And remember, you can only process adjustments for things where you know that there's a difference. You can't guess. And we haven't been told that they're exposed to different levels of competition, so we can't process an adjustment. We then look at the relative age of non-current assets. Once again, no information has been provided, so we can't process an adjustment. We then look at country risk. So for example, if the one company is in one country and the other company is in another country, you need to adjust for country risk. However, Prestige is a South African company. Also, the similar listed company, I'm assuming, unless you're told otherwise, is listed on the JSE. So it's safe to assume both of them are South African companies, unless you specifically know that one's not a South African company, so we can't adjust for country risk. We then need to adjust for the relative size of the entities. Once again, guys, no information is being provided. We do know that the one company is listed. Obviously, this is the multiple of a listed company, and we know that Prestige is a Pty Limited. And obviously, if Prestige is a Pty Limited, we are definitely dealing with a private unlisted company. However, that doesn't necessarily mean that Prestige is smaller than the listed company. So just be careful. You need more information to go that far and actually say that Prestige is smaller than the listed company. Just because a company is listed doesn't by default mean that it's bigger. Okay. However, access to finance, that's definitely an adjustment that we need to make. It will always be more difficult for a private unlisted company to raise new finance than it is for a listed company. That's the whole reason why companies list, so that they have easier access to finance. So that is an adjustment that we are going to have to process over here. Prestige is not listed, so they will find it more difficult to raise finance compared to the similar listed company. All right, and this is obviously a negative factor because it's more difficult for them to raise finance, and if this makes them more risky, remember we need to decrease the multiple. So I'm going to decrease the multiple over here by 1. We then need to consider whether they are reliant on a small number of key employees. Once again, we haven't been given any information that makes us believe Prestige is reliant on a small number of key employees, so we won't process an adjustment over there. We then need to look at the diversity of product ranges. Here we definitely have an adjustment to process because we know that Prestige has diverse offerings, including undergraduate and postgraduate qualifications, whereas the similar listed company only offers undergraduate qualifications. So Prestige has a more diverse product offering, and that will obviously make them less risky, and we will then increase the multiple. Then we need to consider whether there are any specific differences mentioned in the question, and we have already addressed all of the specific differences mentioned in the question. We were told that the listed university only has undergrad qualifications and also that they have a lot more debt in their capital structure. We have considered both of those things. There is nothing else additional that we've been provided with that we need to consider. Then lastly, you just need to consider if there are differences in future growth expectations. So if the one company is expected to grow faster than the other company, we need to adjust for that. Once again, you haven't been provided any information about differences in growth rates in the future, so we can't process an adjustment. All right, so we've considered all of the entity level adjustments, and we can now calculate our adjusted multiple, which is going to come back to 12. We're adding 1 and we are minusing 1.